Very good morning to all of you. Before we start, I'll just take a couple of minutes, a short clip from a movie, Swadesh. It's not a clip. I would like to recite a short incidents that was there, where Shah Rukh Khan, the movie Swadesh, if all would have seen, was from NASA and had come back to India and his village and was introduced by his grandmother to village panchayat. The village panchayat asked like, what does he do? So it was like he makes satellite that revolves around the earth time and again and collects data from atmosphere, and they predict how much it will rain, where it will rain, and the stuff on rains and stuff like that. Panch, all the 5-6 panch of the village, they listened to him and said, इसमें क्या है, ये तो हमारा सहदेव भी करता है. So they called सहदेव. अरे सहदेव आ जाओ तो बताओ अब बारिश कब होगी. And सहदेव was like, he looked at the sky and said, अगले 2 दिन तक कोई भी बादल नहीं दिखने वाला है. So this is like data to the manual, and what is right is like both are right in their own perspective. And similar, if we draw the same analogy to credit risk or underwriting or BSFI and NBFC as a business, so things have changed from paper to paperless, from physical PDs where you say, I have visited the client, I know he'll repay, I have done the PD, to data giving the answers for everything. And now we have a lot of data. Now we have technology to use that data, give us answers right from identity to underwriting to monitoring to scaling up the business, because now world is now in front of you with all this data. So going more into it, I'll open up to the panel, our esteemed panels, and with their experiences, let us go step by step into this entire process, starting with Akhil. So my first question to you, Akhil, is being a product head and currently in business. So what is the ask in terms of customers experience, seamless customer experience, decisioning without human being, model answering the questions and stuff like that? And business want to capture everything within fractions of seconds, maybe. So your take on it in terms of what is that is required.
Hello. This is okay.
Hello. So to start with, so you said it's a product and business, right? So I was part of risk for almost 10-12 years, starting my journey with the risk only. And from the risk, we're able to understand is basically risk is able to understand both sides of the coin, right? In terms of when you are getting some requirement from the market, as well as what you're going to deliver, right? So when you are into a risk, you understand what kind of requirement is coming, and then you can assign, you can say that this is our tweaking or what are the things we can do and achieve the things. So this is from where I moved from risk to product, and the product, when we moved, right? So with this kind of a digital era, a lot of things has been already streamlined, correct? And a lot of things are happening. From the earlier NBFC where a lot of paperwork needs to be done, right? Now there is no paperwork which is required. As well as a lot of analysis or the risk assessment that needs to be happened once the document reaches to some place, right, which needs to be done, which we try to capture across the journey itself, right? So in the product, from the business perspective, we try to build a product which is so seamless, or we can say that when we want to onboard a client, right, it should be an experience for a client instead of simply asking for a loan, right? So this is what, as a product manager, what we are working on, right? So I will take an example. So in the capital market financing, right? So my journey started with the capital market financing. So when you used to give a loan, right, there's a credit appraisal form needs to be filled in, which goes to the risk, they will evaluate. Then once it's been finalized, it's going to communicate, then the loan will be disbursed and all. So what you're going to do in a product, right? So when you are building a journey for a client, so all the parameters will keep in mind, right? And in this kind of digital era, we don't want a customer to move out of a app, right? When say suppose somebody is coming on to for a loan, he should not move out. There should not be a delay, right? In terms of say suppose the customer is waiting for 10-15 seconds, you are losing the customer. So what are the parameters, checks which we can put in place, right? Whether it's a risk check, whether it's a compliance checks, whether it's an operational check. So when a customer is going for a journey, there's a third-party verification needs to be done. If there's a photo needs to be taken, if the photo is not clear, a signature, wet signature needs to be taken. If that is not clear, so the AI has been built in the product itself, that customer should not move to the next journey, and it should be clearly insisting a customer that you need to take a better photo or a better signature and all these things. So this way, when the customer experience improved, what happened is, and with the better risk parameters and controls in place into the journey itself, because a lot of AI has been built, right, to assess the customer when he say suppose download the app, right? There are a lot of metadata which is available, right? A lot of mobile data and other data is available, which evaluate the customers and take it forward. So the overall point is basically, from the product perspective, what we want to build is a seamless experience for a client who is coming for a loan, and instead of dropping or increase the drop rate, what we want to do is to decrease the drop rate and complete the journey in a one-go kind of a thing. So this is what the experience from a business side or product side what we want to build on.
All right. Thanks, Akhil. So moving to Prabhat. So obviously we want end-to-end seamless journey for customer. But the first step in any financial product is identity, which was again, as before it was KYC, paper, address proof and ID proof, and now with data. So has the definition for identity changed, and then how are we moving in terms of identity verification? So yeah.
Hello. Hello. So so far as he rightly said, that any financial services, any financial product, the first step is the customer onboarding or the KYC, or in a more formal and regulatory terminology, it is called customer due diligence. So customer due diligence has actually evolved a lot over a period of time, from paper-based to totally paperless, and from paperless to seamlessly digital. And the core part of this customer due diligence is the identity verification. So it has got two components. One is the identity document, which itself has evolved over a period of time from various kind of documents like ration card, voter ID, driving license, and other identity documents. For the first time, Income Tax Department introduced PAN in India, which was a centralized database. And today we have a 12-digit unique identity number called Aadhaar, which is the bedrock of all the customer identification and customer due diligence. So Aadhaar has actually changed the entire digital landscape across the value chain, not only in know your customer process, but also in delivery of other services, whether in government schemes or in private enterprises.
Thanks, Prabhat. So If we see identity, which was only address proof and ID proof before, it's now moved on to half of the underwriting, basically, which is including the customer stability, including the email stability, mobile number stability, employment verification from EPFO, or maybe the self-employed, I'm just losing the word, but the verification of most of the thing is now part of an identity. So Chandan, so what was before in terms of a traditional identity, and now what is a database kind of an identity check? Where do you think are both fraud prone, or which was fraud prone, or where do we see the fraud risk moving because of this?
Thank you, Nirav, and very good morning to all of you. When we talk about fraud, I think this starts with a very negative connotation, right? I think everyone in this room, whether it is risk guys or anyone in the lending system, when the word fraud comes, that is something we are never prepared, because that is something which kind of hits us when we are not expecting it, and that's the fun part of it, on the fraud side. And it gives a lot of negativity to the entire lending system. So let me start with a positive thing, right? If you look at the published data of Reserve Bank of India, and that kind of compares current year's financial numbers, fraud financial numbers, annualized, has seen a drop of more than 50% as compared to the last financial year. So to me, as a risk guy, this is a massive relief, right? Because we all have seen the way frauds had gone up during the COVID time, because the work from home, complete digitization, we are all pushed to the digitization thing. All of a sudden, we are not prepared, so on and so forth. But this data of 21-22 as compared to 22-23, to me, and I'm sure to all of us, kind of gives a lot of comfort in terms of frauds, in terms of value has come down. But our second part to it is a little trickier, which also says in terms of number of instances of fraud, number of fraud counts have actually gone up by about 25%, little more than that actually. If I join both the dots, what it is essentially saying is that value might have dropped, but the count has gone up, and hence there is more number of frauds happening at a small micro ticket level, right? And to me, this is kind of leading us to two things. One, we all have seen in last couple of years the way micro and small ticket explosion has happened, right? Sometime back, couple of years back, these loans worth 15,000, 20,000, 5,000 were not even thought through, were not even discussed. Today you name the lender, fintech player, everyone is talking about micro loans, small loans, and all that thing. And what it is leading us to, because of the ticket size, there is always an effort to book humongous number of loans, right? Because I then can't book just 100,000 loan. I have to make book 3 to 4 lakhs loans to kind of cover up that kind of value. And number two, because of the small ticket size, customer is always restless, right? I think Akhil rightly pointed out that once customer comes into the mobile app, we really don't want to let him go. So if you look at the TAT, a 1 day TAT to 1 hour TAT to 1 minute TAT to few clicks, now we're talking about 1 click disbursement, right? This is all creating, I think all of us are kind of trying to create that wow, super wow experience for the customer. 99.99 customers are really happy. Come on, we all are customers end of the day, we would love it. But I think that's a small fraction of customers who would take advantage of this, because you have let go some checks, because you have let go some validations, just to keep the experience up there. Some fraction of customer would eventually take advantage, and that's where I think frauds come in. I think the second dimension that I want to bring, which I find little important at this juncture, is that what I call as the multiplicity of fraud. What I meant by that is, if you look at any fraud happening in your institution, you will rarely say that that fraud is a silo in instance. Matlab, if there is one fraud in a lending company, you will eventually find that customer has defrauded about 12, 15 financiers in the same loan ticket size. So while you are saying it is one fraud, actually the same customer has made it multiplied by 15 in the industry. Why so? I think honestly, today if you look at any NBFC, FinTech, even small time banks, the processes, policies, validation, data collection is mostly kind of overlapping each other. There is some delta with everyone, but it's kind of 75% it is the same. So once the customer figures out a soft spot in your processes, he is quickly kind of tapping into multiple organization, and hence there is a multiplication by 10 times, 15 times, and so on and so forth. I think these two is making the fraud ballooned. It is not as big as the processes are making it look like. Way forward, Nirav, if I can quickly summarize, I think without technology, without data, without AI, ML in place, I don't think we would have achieved the kind of denominator that we all have seen. Sometime back, booking 100 loans was so tough. Today, booking 100,000 loans, it's okay. And it is purely driven by the fact that there is technology, there is data, and we are kind of mixing both. But at the same time, if you want to reduce the fraud risk, because that's kind of straight away hitting my top line, the way I think, of course, we'll have to reduce those clicks, those turnaround times, TAT, so that customer gets that experience. But some of the basic checks that we as an individual think that in our organization, given our risk appetite that we need to have, please go ahead and put that. So that there is a delta that you have created from the market, from the rest of us, and that's where customer will get stuck, right? And even if, today, if you look at a fraudster, he is far more tech savvy than many of us.
Right.
And unless we think little smarter than them, they will outsmart us. That's the reality for all of us. I think that's how I look at fraud, and this is how it is kind of evolving. We are in the right direction, just that we need to put some right checks, multi-layered approach. Maybe we'll speak about it little later. Multi-layered approach is, I think, is the most important thing, because you can't just validate one document and then assume he's the customer. Most of the micro tickets, small ticket, we don't even get to meet the customer. We don't even speak to the customer. Unless you kind of bring that multi-checkpoints, customer has a leeway or has a soft spot to kind of creep into the system. And that's how I look at it, and the way fraud is evolving in the current market.
Right. So thanks, Chandan. So what we understand is like identity, fraud, very important from any financial product perspective. And Ajay, in your experience, again on the same thing, if you want to throw some light into the...
Thanks, Nirav. So now as we are talking about digital era, where the lending is on one click, now end-to-end journey has moved to a app-based approval. Entire engagement is just based on the app. So we are not meeting the customers. There is no face-to-face interactions. Then, so fintechs and NBFCs have innovated solutions for customer. Now, on the other hand, at the same time, even the fraudsters have innovated themselves on the same line. They have also innovated, they are one step ahead than us. They have innovated ways to do a fraud, be it on the digital domain, be it related to, if I have to divide majorly into two parts, identity fraud that generally fraudsters do, or there are large chunk of systematic frauds, OTP frauds, Jamtara we all know. So these kind of frauds, they are innovating themselves. With digital lending coming into picture, the ways that we do see how digital lending is helping to control these fraud is, one, now via digital solutions, we can put checks, as Chandan mentioned, around the identity. There are solutions, fintech players, NBFC players are using all identity verification tool, be it a PAN card, be it a Aadhaar card, your regular identity verifications. In addition to that, the digital process has enabled fintechs to even do additional checks. Like while the entire journey is based on the mobile number, there are solutions where mobile number belongingness and mobile number validity, that this mobile belongs to this customer only, can be done. They ask customer for a selfie, and those selfies can be checked against the customer's identity card or ID data. All these identity data are available at a centralized repository. around selfie, around customer behavior during the customer journey. AI and MLs are supporting fintechs and players to identify triggers where the additional checks can be put in, additional frictions can be put in for the customers. To control the fraud part, to control this third-party fraudsters mainly. So these digital checks, on one hand, helping us to identify the right set of customer, and also control the systematic frauds that is happening in large now in this digital era.
So, thanks, Ajay. So, moving from identity and fraud and transaction fraud, coming into the underwriting process, which is very critical from any financial products. Praful, how the underwriting process and how has data changed the process and and the decisioning part of it and stuff like that. So, if you can throw some light on it.
Sure. Thanks, Nirav. Good morning, everyone. So, digitalization or digital lending is making a paradigm shift in the entire world. And when it comes to India, Indian lending landscape has also changed, especially in last decade or so. When with the introduction of Aadhaar and other digital tools. The spur in the digital growth in the lending space is mainly due to tech-savvy users, introduction of innovation and technology in digital lending space, and introduction of 5G now that has also helped. Right now in around 100 million subscribers of 5G are there, which is expected to reach 150 million users by 24. And by 24, 4G plus 5G is expected to reach around 990 million users in India. So there is a huge, tech-savvy users available. They will use the digital technology. When it comes to lending space, especially from underwriting point of view, the biggest challenge or the way in which we are looking is the speed and accuracy, right? We have to give decision very fast and it should be accurate also. So with the use of digital technologies like eKYC, video KYCs are available, and many other verification tools are available which help underwriting to be done digitally, which will help reduction in turnaround time drastically. Traditionally, if we see verification used to take much more time, it used to take 7 days, 10 days time to decide one loan. If we talk about some 20 or 10 years back. But now it's, just Chandan has mentioned, now it is so based on click of a button, you can underwrite the case. So reduction on time and accuracy also. So when customer has all the information available, like bank statement is there, he is getting credits in his banks and ITR and GST and everything is available. With the help of now account aggregator is there and other technologies are there. With that help, we can decide accurately whether customer has credit worthiness or not. And when it comes to informal segment, which is again boom in last decade, and especially post-COVID, we have seen that almost 60-65% of MSME, which are catering to very small and medium enterprises, they are into informal segment. They don't have documents for the income. They are not filing income tax returns or GSTs, but they have income. So to assess their income and their social profiling also can be done through digital technologies and with the use of AI and ML. Now, not only structured or linear data, but non-linear and unstructured data also can be analyzed. Their social profiling can be seen. What is his behavior? That also can be checked. And basis that, underwriting will be accurate. And the biggest advantage of digital lending is the scalability of businesses. So as Chandan and other panelists have mentioned about the, underwriting, initially it was very hard to underwrite even 100 cases, and it was taking much longer time. Now underwriting has taken very less time, so scalability is there. Plus, because of verifications which can be done online, which we used to do physically earlier, now there is no geography limitations. So even the customer might be sitting somewhere else and we are doing underwriting here. So that also gave boost to the business scalability. So with digital sourcing, data-led processes, and right use of innovation and technology, the lending space has emerged a lot. And now the entire lending space is again changing in a better way.
So thanks, Praful. So what do we understand is the entire financial journey, right from identity to credit underwriting, things have evolved, and we are already in a matured stage of data science, and we are there in terms of everything at a click of a button, and the process is kind of a seamless, and things are available. Moving on to the other part, which is the operational risk, which is actually, if we see in past, most of the organization, the biggest collapses are more because of operational risk than credit risk. So other than credit risk and market risk, anything on the universe is coming under the carpet of operational risk. So how do you see digitization helping to monitor this more in a better way, the data and stuff like that? How can we monitor operational risk more effectively with digitalization? So the question to Sydney. Yeah, thanks.
Thank you, Nirav. Welcome all of you to this program. We've heard, more than one panelist today speak of how things are changing. They're changing primarily on two fronts, right? The volumes that we are processing, the volumes that we are expecting to process are going up exponentially, right? And that creates a lot of demands on us, because at the same time, the time that is being taken to process applications is now down to minutes and even seconds. So of course, from an operational risk perspective, a lot of things will change and will have to change. Primarily among those, as I see it, is when traditionally we used to do a review of outcomes, right? Now we have to even more accelerate our shift to an evaluation of design. And design, I mean the design of systems, the design of systems upfront, the rules that go into them or should go into them at the design stage at inception. The corollary to that is, while we've been so far used to evaluating data, evaluating reports, etc., we now need to look at the models itself, the models that are driving that decision on a day-to-day basis, right? Because there's a whole lot of decisioning that is happening based on data, based on rule sets. So conformity with rules now becomes paramount, and our review of those at inception becomes even more difficult, right? So that's the second bit. Now, in terms of rules, we heard Chandan speak about fraud. So there's fraud rules, there's identity rules, there's other disbursement and identification related aspects. With each of these, right, we need to be very clear of what our baseline rules are and make sure that the system is actually has a hard stop with not permitting those. Then you have the softer aspects of exception rules, because as the product heads here also spoke about, we want that decisioning time to come down very significantly. So these primarily are the aspects from an operational risk perspective. What it means is that we will now need to get move our involvement much further upstream than we have had in the past.
So thanks, Sydney. So basically, you're saying the literacy of data science, statistical model, AI, which is currently only with few selected data science guy. So we all, the business and risk also have to be literate to evaluate those models and then take decisions, I guess. So,
Absolutely, absolutely sure, and we'll probably come to that when we're talking
right.
about the challenges here.
Right. So, moving on to one more aspect in terms of credit risk monitoring. Chandan, with data science, again, the monitoring part of it, how that has changed, and if you want to just throw light on the credit risk monitoring part of it.
Absolutely. I think, at least the way I look at it, the monitoring part has changed the max. If I look at AI, if I can ask all of you a simple question, is it okay? If I ask you, how do you think, or how long you think AI as a concept been there in this industry? Just give a guess. There's nothing. AI as a concept, how long you think it's there in the market today?
From a technology perspective, the word has been there for a few years. But AI has been used as a more of human intelligence has always been there to assess either risk in other ways. We are now using tools to kind of make it much more accurate, faster. So that's what I would say. But from pure exactly saying AI as a tool, maybe few years.
Absolutely. AI, I was just reading a report last week. AI is in the market since 1956. It's little more than 65 years now. Of course, as you rightly pointed out, it has picked up the pace in last couple of years because we wanted to now get into where we want to go. And that is possible only if I have data which is now there, fortunately, and then I have to kind of utilize all these tools and then reach there. So 65 years of AI, and just to give a number to this, till beginning of 2020, the AI as a tool globally was valued little less than $4 billion USD. Today, as we speak, by end of 22, this is little less than 15 billion USD. And now from here, it is expected to touch 100 billion USD in next couple of years, that too only for the APAC region, right? If you look at 4 to 15 to 100, look at the jump. And I think all of us are kind of witnessing that phenomena happening around us. Today, I don't think we are doing any discussion in monitoring, risk management, which does not have AI, right? And I think we are in the right direction. Sometime back, I was just mentioning, if I have to reach to that unbanked, underbanked, unserved, underserved population of the country, this is the only way that we can reach. And in fact, at Flexi, maybe I'll just talk 2 minutes about what we do at Flexi. Flexi Loans is a MSME-focused NBFC. It's been in the space for about 7 years now. And if you look at the last published data of RBI, they reclassified the MSME space, and now it is about 10 crore, little less than 10 crore MSMEs functioning in India, right? And a large portion is still not formally funded. So imagine the scope that is left to all of us to kind of go there and fund. But the game is not as simple. I mean, we all know, because once we get into that informal sector, I don't have their banking, I don't have their bureau, I don't know the customer, and hence it becomes little trickier to figure out how much should I give, if at all I give or not, and so on and so forth. I think that is where the alternate data is coming in. Just to give a use case so that all of us understand this a little clearer. If a customer applies from a tier 3, tier 4 cities, he has no bureau records, he has no banking, but I know there is a business which is functioning. Now, how do I give him a loan? I'm just creating a use case that we kind of come across day in, day out. If he's a manufacturing setup, you collect the utility bill that he has. Today, fortunately, we can collect utility bill through a integration, through API and all that thing. And if you look at the utility bill and you see there is a electricity consumption, and you correlate back to if this has to be the consumption and this is the kind of production capacity he has, which visually you can see in the store, there is a correlation. May not be accurate, but definitely you are somewhere there. That kind of helps to take a decision maybe at a 50, 60 platform than till yesterday, which was 0, right? I think this has pushed, and that is what we call alternate data, anything which is beyond the traditional set of data. This is where alternate data coming in, and it comes along with this concept of AI and ML. And hence, once you have kind of this set of data, it is helping immensely kind of take that leap from where we are today to make it, say, 10 times reach. So today, most of our lending institutions are now targeting tier 3, tier 4 cities. Couple of years back, the lending was mostly concentrated on tier 1 metro cities, right? Because for whatever reasons. And thanks to this, the technology again and data, that we are able to look at this in a very positive way, very progressive way, and I think we're in the right direction. Coming back to the second concept of how monitoring is really working, imagine if I've created a 500,000 customer base, and unless you really monitor these customers and kind of reclassify continuously as to how they're kind of stacking up in terms of high risk, medium risk, and low risk, you would only keep yourself busy in acquiring more and more customers, and this portfolio or the value of the book that you have created might topple off. And hence, there are a lot of algorithms, there are a lot of integration, a lot of partners now that are available without you yourself creating. You can consume a lot of data, which will give you almost real-time data. Say, for example, he spoke about the data which you can get from GST, social media data, which may not be real-time, but almost real-time. If I ping bureau, it may not be real-time, maybe with a month lag. I'm sure all of us can kind of playing in that area where data is available, maybe immediately, maybe with a gap. But the critical part is that once the data comes in, then I'm able to run a tool which was not there some time back, and hence kind of recalibrate my portfolio time and again to see what I envisaged the portfolio to be at some time back when I onboarded the customers or a cohort of customers is exactly the way today it is. And if it is not, what has changed, and hence what kind of policy measures that I need to take. This intelligence was not there. Maybe was there manually. Underwriter, risk managers used to sit together and figure out what to do. Today it is data driven, and it is helping, I think, immensely all of us to kind of go where we are going from here.
Yeah. So thanks. And then, so one of the example, even say we are also developing models for underwriting. And again, being at Aadhar, we work with the segment who takes a loan of around 6 to 8 lakhs or 10 lakhs. And along with it's a mortgaged, it's a collateral based. So again, if we speak about the alternative data, I do a receive visit and understand the customer, the applicant. He has couple of kids going to school. He has a fridge. He has a TV. He has a cable TV. He is feeding his parents. So around 3 to 4 dependents, three dependents. So other than that, so obviously he must be making 20 to 25,000 kind of stuff. So, but then again, how we consider all these factors into model to just go ahead with this kind of model, we are still figuring out. But alternative data, and we can just think what can be alternative data. Anything and everything can be alternative data today. Yeah. Moving on. So Prabhat, we spoke about identity, and then again the credit part of it and operational risk part of it. If there are any examples of specific areas where we see digitization has added value, and how are we drawing efficiency because of digitization? If you can throw light on some of those areas.
Within the customer due diligence?
Within the customer due diligence or the entire digitization, the financial life cycle.
From risk management point of view, I see more and more use of data analytics for decision making. So it is data driven decision making, both at the industry level as well as at the regulatory level. So whether it is Securities Exchange Board of India or RBI or any other regulatory agency, GST or others, they are the collection of data is for everyone, for industry players as well as for the enforcement and regulatory agencies. So I see more and more as more and more commerce and business increases, more and more tightening of the rules and stricter enforcement of the rules, particularly around cyber security, because in recent past we have seen lot of attacks, and it's a continuing phenomena, the kind of attack that happened in Ames, ransomware attack, and is happening on a everyday basis. Another thing is the what do you call, too much of its data overload. So picking up the discarding the noise and picking the right information which is material to the decision making, that is going to be the key.
Right.
That is where the human element
Right, will
also
come in.
comes
Right,
in. Yeah.
right. So, thanks. So, Ajay, where do you see, or how are we, so with digitization, how are we adding to the efficiency, and whether we are able to measure this efficiency coming in, whether it be underwriting part of it or even the transaction processing part of it?
Yeah. So especially coming first part on the underwriting part of it, in terms of efficiency. So as a traditional method to do underwriting, say if I give my file, I apply for a loan, and if I give my file with the same set of data information about the income and salary slips and everything, two different underwriters, there are high probability that decision may be different for both in terms of amount, in terms of approval. Both may, using the same information, both may come up with the different decisions because there is a manual interventions there. Now with digitization, how it has helped us mainly to come up with a systematic decision, with the same decision for same customer or same set of customer. That is the biggest point that I do see one thing. If the information is same, however times you do run your decisions, you run your rule engines, your output is going to be the same. So that is one thing. Second thing that has created a delta, that digitization has now enabled us to do a multiple level deep dive using the same information which was available earlier for a decision making, for underwriting decision making. Now all the AI, ML tools, all the modelings has helped us to create a multiple fold information, multiple correlation between the information, which generally underwriter do see the information of income, or do see that this guy is paying a rent or is staying on a rent as an individual variable, as an individual metric. Now AI, ML and digitization has helped us to create a multiple fold, multiple correlation around these kind of variable. So that certainly has helped. Additionally, as Chandan and other mentioned, that there is a lot of alternate data now that is available, in addition to traditional bureau data or income data for the customer. That is helpful on the MSME domain, and especially helpful on the retail domain, where your decision need to be quick, and as we were talking about a 15,000 loan, 20,000 loan, small loans, where we like to underwrite based on the limited information. We don't want customer to give 10 different documents. So that certainly has helped us. While all these things has changed a customer experience, a quick turnaround time, there is another factor that these digitization has helped lending partners is in terms of customer acquisition cost. That certainly has come down, and that certainly is adding as a profit for all the lenders in terms of digitization. And in parallel, customer satisfaction is there because now turnaround times are small, decisions are quick, decisions are more accurate. Customer don't need to give 10 different documents now. Informations are available via digital routes. So customer is also happy. Customer satisfaction is higher. Lenders are able to acquire at a low cost. their higher accurate risk decisions with this digital lending platforms now?
Right. So obviously everything has changed. A lot of benefits, but moving on to challenges. Right. So it was to you only, Akhil, in terms of challenges as well as the whatever in terms of benefit, the point you want to add.
So it's basically not a challenge now. It's much more into a benefit side kind of a thing. So earlier, what you were not able to do, right, in terms of the digital era, we were able to do a lot of things, right? Say suppose a customer coming for a loan, and we don't know, right, what his requirement is, and if you are able to meet the requirement some other way. So we have seen in the capital market financing, we try to do one of the things is basically a customer when he's coming for a loan, he wants ready to give his shares or mutual funds or other asset class, right? But he don't know at what rate and what kind of loan he will going to get, right? So in the digital era, what we are able to do is we are able allowing our clients to play, right? In terms of, say suppose I don't want to give my shares, I'm ready to give my mutual funds. So what is the rate of interest? No, in the mutual funds, don't want to give my top 3 mutual funds. I want to give the other 2, right? So with the risk settings or parameters which you placed, right, it's give very comfort to the clients when you keep on swiping or changing, right? So automatically the rate of interest, right, we able to change, right? So customer know what the risk reward I want to do, as a company will know what the risk reward. So company know if I'm taking some shares or security which is a high risky kind of a thing, or there's a larger exposure already been there in the market, so they can put a higher rate of interest and what kind of a control they want to put in place, as well as the customer also know that which stocks I want to lend, right? And the instantly in the upfront of the screen itself, we will be able to know, yes, on this against this security, I will be able to get the loan, right? This is a big thing which happened, as well as there is again a defined list which has been run by the RBI, right? Other than that, if the company is comfortable, other than the RBI defined list, what the product you can make, right, in terms of a secured loan against securities, that if we can take unapproved securities also, right, it will not come as purely an unsecured kind of a thing, because customer is able to provide something. Earlier we were not able to know, customer not able to provide only. So this is a good change which happens, right, with the lot of digitalizations which has came in. And the challenges piece is not such big here is, the challenges will be much more into when you want to cut short the journey, right? There can be a lot of challenges, but that also can be addressable by with a lot of regulatory help which is coming right now.
So thanks, Akhil. Sydney, again, throw some light on the challenges and how do we overcome those, so in terms of the digitization and the data.
So Nirav, you alluded earlier to literacy, right? Data literacy, system literacy. That's from an ORM perspective, that's primarily the challenge we are facing right now. It's a question of skill sets, right? Up until a few years ago, the kind of skill sets we were looking at is someone who could identify issues from data, reports, and stuff like that. Today, it's more about the model, right? Can you are you able to audit the model? Are you able to see flaws in the model? So in a way, and then again, our involvement is expected to be much earlier.
Right.
Now, that's looking at it from an inward-looking perspective, if I might say so. If I look a little outward towards the product and the business teams, right? In a data-driven environment, they are expected to be agile. So their need is to develop, to improvise, to deploy very quickly. So in that situation, if we are looking to get involved earlier, it means that we are actually, attempting to swim upstream. So it's a lot harder now to get involved upstream, and then again comes in the issue of skill sets, etc. Because typically data models are, within the domain of
like a black box kind of.
Black box and essentially developed by the tech teams, basis inputs from product teams, then again looked at by data scientists and stuff like that, right? So getting in there early is quite a bit of a challenge, right? But then there's a good side to it, which is that with the kind of volumes that we are looking to process and the diminishing decision timelines, a misstep can be very costly, right? So then the kind of save that you have by actually getting there early, looking at the rule conformance logic, vetting that before deployment, etc., that can be very advantageous in bringing down those operational risk costs in the medium to long term.
So absolutely agree, and I think we must all have faced this challenge, being not so data science or statistical literate, and I think a major challenge as of today for all of us. Praful, on underwriting piece or even the credit monitoring piece, again, the challenges that we are facing, if you can highlight those, and how do we remediate?
Yeah, I'll talk about, as Chandan was mentioning about catering to informal segment, especially MSME and housing finance and small ticket loans. So I am from housing finance, especially affordable housing finance, where in underwriting, the biggest challenge is to assess their cash flow. Though there are, we talked about ML for the use of unstructured or non-linear data, but still there is lots of challenges as far as customers' cash flow assessment is concerned. Still the credit manager has to go to the customer's business place to assess their cash flow, and which is the piece in entire underwriting, right from sourcing till sanctioning. It is outside the system, and then again credit manager will come back to the system and he will punch in his data. So that piece is still requiring digitization, or digitalization will have to play a big role there, which I see maybe in coming couple of years, or maybe by 25 we will have some work there. And so that's about the profile. So when it comes to lending against immovable properties, especially housing loan or loan against property, the second part is property, which plays a crucial role equivalent to profiling. So when it comes to unsecured lending, only profile is there. You will see his bureau scores, his bank statement, whatever his behavior, social profiling, and then we decide. But here property is also there. In case something goes wrong with the profile, I will have recourse to go to the property and recover my money. But when it comes to property, it is equally complicated piece wherein it's legal and technical and other parameters we will have to check, which are again dependent on some agencies and outside the system. So that piece is still not fully digitalized. In property itself, the biggest challenge we face as a lender is the state laws. Each state has different requirements. So when it comes to a big country like India, each state is like a different country, when it comes to lending against properties. Because their mortgage requirement is different, their still ATAs, agreement to sell and sell deeds, still they are getting registered physically. So customer has to go to the sub-registrar office and register their sell deed, which will take around 2 days, 3 days, depending upon the SRO. They will give us the physical copy, and then actual money will be given to the seller or builder. So this lag means post-sanction or post-booking leg, it's still open for digitalization, and there is lots of things to be done. When it comes to monitoring part, there are multiple tools available which helps the finance companies and lenders to evaluate their existing portfolio, which help in AWS early warning signals and deciding about the probability of default, and so many things are there in terms of portfolio monitoring. Thank you.
So thanks. So I would just like to conclude on this before we have a couple of minutes then for panel discussion. Any questions, if any, from the audience? So it's like data and the technology, everything is available. We have huge promoters with a lot of money want to capture the immense market which is available. There are people from data or the technology or the data science with ready to use technologies, and there are risk officers like us who are standing on guard. We are guarding this, and our job is to prevent any unforeseen event that may happen in future. So that is the current situation, which is, I feel, a very tough situation as of today. And with that, I would like to close this discussion and open it to the floor if there are any questions.
Chandan, maybe a question to you. There's a lot of things that you spoke about, lending in tier 2, tier 3, tier 4 cities, right? And we look at AI as a model to that part, but it's more about the modeling that we do at the back and using certain tools like machine learning. Is there some way where, ethical AI gets into play, where at times it has happened that because of certain demographic or for some various reasons, right, this model does not, or maybe at times gives a specific kind of a data output, which probably impacts, somebody who's really qualified to get, the loan or the lending doesn't really get. So what is it that's been done? That's one question. And second is also about, the fraudster doing probably at the similar ticket value, doing it at multiple places. Is there areas where we've seen blockchain helping you from that perspective, where something gets into it as a register and then needs to be authenticated by somebody else? So maybe have you seen a blockchain as one of the tools being leveraged in your in NBFCs?
Your good name, please.
My name is Sanjeev.
Sanjeev. I mean, really thanks for asking this question. This is a very pertinent problem for all of us. Today, all of us are kind of dealing with this issue. So let me try and answer in that sequence that you asked. Today, this is actually one of the lacuna or one of the struggle points in the entire AI scheme of things. Data, of course, I mean, more the data, better the AI output is. Sometime back, the availability of data itself was an issue, because we didn't have data and hence AI model was not throwing the right result. Today, I think excessive data is the problem, because we have so many sources, data available. Trust me, majority of the time of the data scientist today is spent in figuring out which data is pertinent, which data to keep out. Maybe in phase 1 we will take this, phase 2 we will take the other one, we scrap this. Just to figure out what is relevant takes half of their time. But having said that, what I felt, see, the model can only speak as much, right? Because the model is not telling a particular customer, it is talking about a cohort of customers. So when you are talking about, say, a particular customer, say in tier 3, tier 4 cities applying for a loan, and my model says he is high risk, that's where I come to, which is called as in the AI model, it is, I mean, at least I call it as a mindset issue. Not an issue as such, it's a mindset gap, if I can say so. Because AI is only throwing what it is reading from the data, right? And as Ajay was speaking some time back, if you give the file to two underwriters, both of them can give a very different opinion about the same customer with the same set of documents. And if there is a manual slippage there, of course it can happen in the AI world also. What is triggering in the, this change of mindset in the AI, if you look at a particular customer who is, say, graded as a high-risk customer, and prima facie in the bureau there is nothing wrong, in the banking nothing wrong, that's when the business guy will kind of come back to you saying that, come on, how have you scored them a high-risk customer when there is nothing wrong in the bureau, nothing wrong in the banking? I think that's where the mindset thing comes, is that model is not predicting for that customer. It is kind of looking at that set of similar set of cohort customers, and hence there could be an exception. Because perfect is something that we can't achieve. All that is AI, this model is helping us, is to go from, say, 90 to 95 to 97 to 99, but still there will be a 1% customer which is left out, and hence we as risk managers play that exceptions role. If we are convinced that, okay, AI model is saying it's high risk, then we go through the file manually. This time we keep the AI model out. go through the file and then kind of take that exception. Okay, I feel that this is fine. But I think what it actually creates a trouble is that as more and more exceptions are taken, as more and more overarching policies are built on the top of the model, eventually the model will fail. When the result comes for us to see, we all will see that it is not rank stacking. It is not showing the way we thought or we envisaged when we kind of went live with this. The key to this is that to kind of do a training across departments, be it business, be it product, be it risk, be it DS, be it technology. All of us as an organization, if you can get aligned to what exactly AI is saying. I mean, now we have moved from AI to explainable AI, right? Government that kind of already asked for it. So it is clearly explainable to all of us. The data science team can go ahead and explain to all of us. We will go and speak out and discuss. Once that mindset shift happens that no, what my AI model is showing, it is right. Maybe there could be hardly some exceptions and we are all there for that. But we'll have to kind of live with the fact that there will be some exceptions. I mean, beyond a point, we really can't help it. That's how I look at it.
Yeah.
Sorry, I think we have run out of time.
Well, ladies and gentlemen, a big round of applause for the gentlemen for sharing their valuable insights with us. Thank you so much for this beautiful panel discussion.